delegates from various financial institutions, guest speakers, and colleagues from CAFRAL. A very good morning to all. At the outset, let me thank CAFRAL for hosting this learning program. The lingering COVID-19 pandemic and the potential economic disruptions due to the latest geopolitical events in Europe have again brought to the fore the reality that the nature and frequency of risk faced by the financial system of today are quite unparalleled and unpredictable. Also, the banking sector today is much different from what it was a decade ago and is constantly evolving. While the Reserve Bank is deploying tools at its disposal to maintain the stability of the financial system, individual financial institutions, more specifically, the banks, need to be watchful of the economic impact of such risk events and take adequate measures to maintain their resilience. In this regard, it is important to recognize the interlinkages between quality of governance and resilience of financial institutions. Even as high quality governance enhances resilience, poor corporate governance is a source of risk to the financial institutions as well as to the financial system. While good corporate governance is essential for all institutions, the governance structure and processes of the banks are expected to be even more robust. Banks and financial institutions are different from other financial entities in many ways. Their business model is very different from other business entities. Enjoy high leverage as they can raise substantial amount of uncollateral deposits and perform the function of liquidity and maturity transformation. Hence, the governance structure and practices in the banks should prioritize protection of the interest of their depositors. With the growth in size and complexity of the financial institutions, there is an increased focus on adequacy of the governance framework for identifying, addressing, and managing risk. Towards this, the three lines of defense have pivotal responsibility. The business functions, which are the risk taker and owners of the risk, that is called first line of defense, have the responsibility of managing the risk generated by virtue of their day-to-day business activities. The risk management function and the compliance function, called the second line of defense, have the responsibility of exercising oversight on the business functions to ensure that their activities are within the risk and compliance policies of the bank. And third, the internal audit function, called the third line of defense, has the responsibility of identifying gaps from prescribed requirements and reporting to the board audit committee of the board. Collectively, these three functions have to provide assurance to the board or the senior management about the adequacy and effectiveness of the governance framework and that the board approved policies and business strategies are adhered to by the financial entity in conduct of its business. Let me now briefly touch upon RBI initiatives and the measure taken by RBI. The Reserve Bank attaches a lot of importance to the strengthening of governance and internal control function in the banks and financial institutions. Recent guidelines issued by the RBI are intended to provide greater clarity on avoid conflict of interest, provide sufficient authority, resources, and independence of these functions, among others. In September 2020, RBI has issued revised guidelines for compliance function in banks and role of chief compliance officers to bring uniformity in approach followed by banks, as also to align the supervisory expectations on CCOs with global best practices. Internal audit. Earlier in January 2020, RBI has issued guidelines for strengthening governance arrangements with regard to risk-based internal audit in banks, which inter alia included enhancing the authority, stature, and independence of the internal audit function. Similar set of guidelines were issued for select NBFCs and UCBs in February 2021, which were later extended to select housing finance companies as well. On risk management, though RBI has issued guidelines on risk management system for banks way back in 1999 to bring uniformity in approach followed by banks, as also to align the risk management system with best practices. Guidelines on the role of CROs in banks were issued in April 2017. Similar guidelines for NBFCs and UCBs have been issued in May 2019 and June 2021 respectively. RBI has also undertaken sensitization sessions with CCOs, CROs, and head of internal audits over the past year to communicate its expectation on oversight and assurance functions. Now let me touch upon the governance in commercial banks. Through a discussion paper published in June 2020, Reserve Bank has proposed substantial improvements to the governance framework of banks. Major highlights of the discussion paper were: empower the board of directors to set the culture and value of the organization, recognize and manage conflict of interest, set the appetite for risk and manage risk within the appetite, improve the supervisory oversight of senior management, empower the oversight and assurance functions through various interventions, achieve clear division of responsibilities between the board and the management, and encourage the separation of ownership from management. Based on the suggestions and feedback on the discussion paper, Reserve Bank issued instructions regarding the chair and meetings of the board, composition of certain committees of the board, age, tenure, and remuneration of the directors, and appointment of whole-time directors in April 2021. With respect to other proposals contained in the discussion paper, a master direction on governance will be issued by RBI. Additional Director in her opening remarks talk about it sharing supervisory assessments and the supervisory concerns identified through various supervisory cycles in today's keynote address. Let me briefly touch upon RBI assessment and its findings on oversight and assurance functions. During recent years, assessment of oversight and assurance functions has been bestowed enhanced focus in view of their importance in addressing the root cause of problems. Some of the common weaknesses that have been observed in these functions are: let me first talk about compliance function. Failure/delay in detection and reporting of non-compliances, persisting subpar compliance, deficiency in compliance testing with respect to inadequate coverage and limited transaction testing, persisting irregularities due to non-addressing of root causes and not ensuring sustainability of compliance were observed. Further, compliance setup was not resourced adequately with required number and quality of staff in many cases. Let me give a brief overview of the risk management, the finding on risk management. Disconnect was observed, and that's very, very important. Disconnect was observed between the risk appetite framework as approved by the board and actual business strategy and decision making. There should be an interlinkage in all the three pieces, whereas we find that there are gaps in all these three pieces and they are not interlinked and working in silos. The weak risk culture, which was amplified by absence of guidance from the senior management, the lack of senior management involvement in creating the risk culture, improper risk assessment, repeated exception to risk policies. Now, the bank's risk policies or the RBI's guidelines, repeated exceptions were observed. Conflict of interest, especially in related party transaction, and absence or faulty enterprise-wide risk management. I need not to tell upon from the past events that was the major conflict was observed in many banks pertaining to related party transaction. Operational risk was seen to be high on account of people risk. I will draw the attention of all the MDs and CEOs and the other senior management people present here, and through them to all the banking fraternity. These are the major areas which need to be addressed at your end as well as the board level. The people risk, and in the people risk, what we have observed: high attrition rate, lack of succession planning, involvement of staff in various unethical practices. So whistleblower policy is not very effective. So these are the three broad key areas in people risk. And as we are in a service sector, I think that's very important that we need to address the people risk very effectively and very promptly. Second risk, which Director CAFRAL also mentioned in his address, elevated IT and technology risk. You know very well the way technology is evolving and the technology is occupying the traditional space of the banking. It's very important that we need to keep the pace of the technology adoption. But what we observe, the lack of adequate investment in technology, lack of technically qualified personnel, business disruptions, and weak BCP-DR arrangements, etc. The third area in the operational risk, what we observed, the high outsourcing risk. Yes, it is desirable to have a expertise or rather leverage on the expertise available in the market, but over dependence on vendors, lack of monitoring arrangements, gap in contractual agreements were the key highlights of the supervisory concern observed in the outsourcing risk. Now, let me touch upon the internal audit. The audit process unable to capture irregularities that we have observed in large number of organizations. Known coverage of certain areas under scope of audit. Compliance and audit not collaborating with each other. Both are working in independent of each other, whereas both are playing a complementary role. Lack of ownership and accountability. The audit work is just identifying the gaps and then leave it. Inadequate review of practices that require alignment to address interest of all stakeholders. Non-compliance or delay in compliance with audit observation. These were some serious concerns we observed in the audit function. Quite often I wonder when the supervisory team, just within a short span of time, is able to identify various weak areas and various gaps in the functioning of the banks, why the internal audit, which is a regular job for them for 365 days, are unable to identify those weaknesses or those gaps. I request all the participants present here that they need to focus on these three major assurance functions and the oversight function. Now, let me touch upon in this keynote address what are the supervisory expectations on governance and assurance functions. The first, effective engagement and support from the top. Oversight and assurance functions have a key role in value creation for a financial institution, strengthening public confidence, preserving and enhancing its reputation, and maintaining the integrity of its business and management. The board should engage with the oversight and assurance functions and assure them of direct and unfettered access. The tone from the top would set the pace for a sound organization culture that values honesty and integrity. That is the major area what we have observed as supervisors. In many entities, the tone from the top was really missing. Second, independence of oversight and assurance functions. Board must ensure the independent functioning of oversight and assurance departments. The third, close engagement and collaboration. Maintaining independence does not preclude constructive engagement with management and business function. Indeed, to be effective, heads of oversight and assurance functions must work closely with other functionaries and also collaborate among themselves. Fourth, sustainable compliance. Several weaknesses and irregularities have been recurring despite the averments made by bank managements of having carried out remediation. My expectation from the banks is that they make serious efforts towards overall improvement and sustainability in their compliance. Fifth, risk governance. Risk appetite and risk tolerance levels must be clearly defined. As I said, the major supervisory concern, a gap between the risk appetite, business strategies, and the business decisions. So risk appetite and risk tolerance level must be clearly defined, keeping in view past and forward-looking assessment of likely internal and external risk environments, and actual business decision making should align with these limits. as also with the capacities available with the institutions. In couple of organizations, we have seen the growth was not commensurate with the internal controls and the oversight and assurance function. Rather, the growth undermines the assurance function and the internal control. The senior management should communicate the risk management policies, risk appetite statement, and risk management expectation to the business units for proper understanding and compliance. Despite issuing the guidelines in 1999, and many banks have set up the risk management department, rather almost all the banks have set up and they are having the CRO, but still it is observed that the risk culture has not been percolated down in the organizations. The business units are independent of any kind of risk assessment, and rather business overrides the assurance function and the risk function. Six, the quality of board discussion and time given for important matters. That's again very important for all the board members and the directors. And that role has to be played by the executive management. The board members should focus on strategic and important matters. The quality of deliberations, the level of challenge provided to executive management, and the time allocated to important agenda item is often found to be inadequate. Many items, large number of agenda items are included as a table item, which don't allow for proper evaluation of the proposals. The board also needs to work in cohesive manner. That's also very important. In a couple of organizations we have seen the board is not very cohesive and the board environment is not conducive to the functioning of the bank. 7. Role of board and senior management in cyber security and technology. RBI has mandated banks to have awareness training programs for their board of directors and senior leadership team and to familiarize them with IT and relevant cybersecurity concepts. CAFRAL has initiated this initiative for quite a long, and now they are focusing on cybersecurity and providing the training to the board members. I'm very happy and compliments to the CAFRAL. The board must start looking at cyber risk as an enterprise-wide risk management rather than a pure IT security issue, owing to its firm-wide implications. Adequate and required level of investment in technology should be ensured. Quite often we have seen the scalability of the system is faltering, and despite of having the budget allocation and the budget approval from the board, the spending on the IT was not adequate enough in proportion to the size and the volume of the bank. In its role of oversight, the board needs to oversee the overall cybersecurity management, including appropriate risk mitigation strategies, systems, processes, and controls. Whether the institution has the appropriate skill, resources, and approaches in place to minimize the cyber risk and mitigate any damages that may occur also needs to be seen. Quite often we have observed all these cyber risk related issues and the IT related issues are left to the CTO alone. I will request all the participants present here and through you to all other board members that there should be a more vigilant board with regard to the IT investment in the cybersecurity. The eighth point, which is very, very important, I would like to highlight the dominance of individuals. It is important to ensure that financial institutions are board driven and don't end up being dominated by individuals. Experience has shown that this leads to undesirable consequences. I stop there. I don't want to explain in detail. You all are the best judge. The last point on the supervisory expectation, oversight over related party transaction and connected lending. While various regulations are in place to check improper related party transaction, including their disclosures, it is important that the board and audit committee exercise close oversight over such matters and get satisfactory assurances. Many times we have seen that the related party transaction, whatever explanation is given in the board by the conflicted party or by the management, has been accepted by the board members. I will urge upon all the board members to really get satisfactory assurance before passing through any such transactions. Now let me touch upon certain things that as a banker or as in the board and as a supervisor, what pertinent question a board member should ask while deliberating in a board meetings. So I just list out few questions which probably the board member must be asking. And if they are not asking, I feel from my experience that they must ask. Is the bank's strategic plan realistic for the bank's circumstances? Is the bank's business risk taking in alignment with its approved risk appetite? Is management meeting the goals established in the planning process? If not, why? Do earnings result from the implementation of planned bank strategies or from transaction generating short-term earnings but long-term risk? And that is one area where we have found that banks are entering or entered in the past also into a long-term risk in lieu of the short-term gains. Are policies and procedures in place that safeguard against conflict of interest, insider fraud, and abuses? Does the bank have sufficient capital to support its risk profile and business strategies? Are financial reports and statements accurate or reflect true financial conditions of the bank? So quite often we have seen large number of MOCs given by the statutory auditors, the qualification in the balance sheet, and supervisory team find out the misreporting in the balance sheet in couple of cases. Are the strategies of the bank aligned with the future needs and requirements? That's very important because we have seen banks are not basically preparing themselves for the future needs and requirements. And the last point, the last question, is the bank spending on IT systems adequately to maintain robust IT infrastructure and make it scalable as per the growing needs and challenges? That's very important because the way technology is evolving, the people used to say in the times to come, banking will be everywhere except then the banks. So are we preparing ourselves for the future challenges, the technology disruption and the technology adoption? Let me now conclude. An efficient and vibrant financial system is crucial to economic development and social well-being of the country. The governance framework surrounding the individual players in the financial system assumes a central role, not only in terms of value creation for various stakeholders, but also in ensuring the oversight of the board on risk appetite and risk culture of individual institutions. Effective internal defenses will help in building organizations that are strong, resilient, disciplined, and enjoy the benefits of sustained growth and customer confidence. It will also be preempt supervisory action and attendant reputational risks that arise in case the transgressions are detected. I am quite hopeful that proceedings of this seminar will add value to all of you, and I am also confident that all of you will espouse a robust governance culture at the banks and financial institutions you are associated with. I once again thank CAFRAL for hosting this important seminar and for giving me the opportunity to address all of you. Thank you.